Real estate investing rules of thumb, the 2% rule, the 50% rule, and the 70% rule. There are some rules of thumb that can help investors quickly screen through deals to make a good educated guess on whether or not to pursue them. Now, this is important. Notice that I didn't say there are some rules of thumb that can help investors make purchase decisions, because rules of thumb are not meant to be hard and fast rules. They simply help an investor get a quick and dirty opinion on some valuable metrics. Always do a proper analysis. But regardless, these rules of thumb can come in really handy in saving you from analyzing every single deal that you come across. My name is Brandon Turner, and in this video, I've outlined several of the most common real estate math rules of thumb so you can begin practicing them in your own analysis of properties. The 2% rule, also known as the 1% rule or the 2% test. Perhaps one of the most common rules of thumb used by rental property investors is known as the 2% rule. But not because it's a rule, so I say 2% test. I like that better. Essentially, this rule of thumb looks at the monthly rent divided by the value of the property in a percentage form. For those who just got confused, let's make this super simple. If a property rents for $2,000 a month and the value is $200,000, then 2,000 divided by 200,000 equals 1%. In this example, the property does not pass the 2% test, but it does meet the 1% test. Exactly. Or what if a property that rents for $1,500 a month and it costs $180,000 to buy? Well, $1,500 divided by $180,000 is 0.8%. That's definitely short of the 1% rule or 1% test. Now, what if that property rents for $1,500 a month, but it's worth $120,000? Well, $1,500 divided by $120,000 equals 1.25%. All right, so you get how the math works now, right? But what does it mean? Well, essentially, the 1% or 2% test gives us a quick and dirty view on whether or not the property will produce positive cash flow. And of course, just a rule of thumb, it isn't always precise, but generally speaking, the higher the percentage, the better the cash flow. This also greatly depends on location, price, and how much the expenses truly are on the property, but the rule of thumb can help an investor make some decisions on whether or not to pursue a certain property. For example, I know that most properties that fall short of 1% will likely never produce a positive cash flow for me. If it's between 1 and 2%, it probably will. And if it's above 2%, which is really hard to find today, then I'm almost positive that it will. So if my real estate agent tells me that they have a perfect rental house for me to buy, and I see that the purchase price is $125,000, and I find that it will rent for $1,000 a month, I can make a very quick decision, and I know that most likely that deal ain't gonna ever provide cash flow because it falls short of the 1% rule, because 1,000 divided by 125,000 equals 0.8%. In a case like this, I probably wouldn't even spend any more time looking at the deal if I was only interested in the cash flow. So that's the value of the 2% rule test thing. While the 2% rule and the 1% rule or test we just mentioned, they can help you get with a go, no-go decision on looking further into a rental property, it doesn't really tell us how much cash flow we might expect. For that, investors often rely on the 50% rule of thumb. The 50% rule states that on average and over time, half of the income in a property is spent on operating expenses. Now, what are operating expenses? Well, good question. Operating expenses are all of the expenses involved with running a rental property, except the loan payment. So it includes taxes, insurance, utilities, repairs, vacancy, and other metrics that leave the landlord's checking account every single month or every year, depends on how you want to look at it. The 50% rule can help an investor quickly estimate the cash flow of a rental property because it combines all of those expenses, except for the loan, into one easy number, half. So let's work through this. Imagine a property rents for $2,000 a month. The 50% rule says half of this, $1,000, will be spent on expenses. This means we're left with $1,000, but now we need to make the mortgage payment on this, right? Unless you paid cash for the property, but let's say you didn't. So with that $1,000 we have left, let's say the mortgage is $600. So how much do you have left? $400 because 2,000 times 50% equals 1,000. 1,000 minus 600 for operating expenses is $400 in cash flow. That remaining number is what you can estimate over time on average you might get in monthly cash flow. Of course, that 50% estimate on operating expenses can really vary wildly depending on the property. In some areas, taxes and insurance might be incredibly high, but in other areas it might be much lower. Some properties require that the landlord pay all the utilities, where other properties allow the tenant to pay their own. And while inherent weaknesses do exist, the 50% rule does have value. I mean, when you're looking at a property that rents for $1,200 a month and you know the mortgage payment would be around $1,000, you can pretty much guarantee that property will not produce a positive cash flow because $200 a month is not a lot of room for all those expenses. Because 1,200 times 50% equals 600. 600 minus 1,000 is negative 400, right? Now, the 50% rule helps keep real estate investors in check and to remind us that there are a lot of expenses that over time add up. Yeah, I mean, a new roof is only needed every 20 years, but if you divide a $10,000 roof into 240 months, that roof is actually costing you $42 a month, every single month. These operating expenses add up over time, and as most investors have seen, they tend to settle around 50% given a long enough time frame. Okay, on to the final rule of thumb today, the 70% rule. The last couple rules of thumb that we talked about were designed to help rental property owners, but what about the house flippers, the wholesalers? I don't want to leave you guys out. So for those who are flipping houses, the 70% rule can be helpful in determining just how much to pay for a property. The 70% rule states that the most you should pay for a potential flip is 70% of the after repair value, like what it would sell for when it was all fixed up, minus the repair costs. So example, if a home would sell for 300 grand all fixed up and the property needed 50 grand worth of work to get there, then 300,000 times 70% is 210,000. Subtract out that $50,000 and you're left with 160K. According to the 70% rule, the most someone should pay for that property would be 160K. But of course, there are problems with the 70% rule. This rule of thumb assumes that 30% of the ARV, the after repair value, is going to be spent on holding costs, on closing costs, on the buying side, the selling side, commissions, taxes, attorney fees, title company fees, and more, and the flipper's profit and any other charges that come up during the deal. Now, this works well in some markets, but it has some severe limitations. For example, the 70% rule doesn't really work that well for a property with a really low ARV, after repair value, such as $50,000. As mentioned earlier, the 30% deducted from the ARV includes the holding costs and the closing costs, as well as the profit the investor or the flipper wants to make. However, like 30% of 50 grand is like $15,000. So following the 70% rule, all of the fees, costs, and profit would only be 15 grand. If the fees and holding costs were to total like 10 grand, that would leave just $5,000 in profit for the house flipper. And I don't know any house flipper who's gonna take on the risk of flipping a house for just 5 grand. So, following the 70% rule, a flipper or wholesaler would pay far too much for the property in this example. An investor flipping houses at this level might require far less than 70%, maybe a 50% or even lower. Now, a similar problem exists with the 70% rule for more expensive properties. The 70% rule would dictate that a home with an ARV of 700 grand that needs 50 grand to work should produce a maximum offer of 440,000. But in most markets, finding a $700,000 property for $440,000 is simply not feasible. A person who sticks exclusively to that 70% rule are likely never going to find a good enough deal to ever flip a single property in that market. In this case, 80% or even 85% might be good enough. Furthermore, some investors may spend more or less on fees and costs because of their particular life situation or location. For example, in some states, purchasing a home may require 3 grand in closing costs, while in other states, it might be $6,000. Some investors may have a real estate license, which saves them tens of thousands of dollars in commissions, whereas other investors, well, they may need to pay commissions when they actually sell the property. So, how should the 70% rule be valued? Well, carefully. It's a quick and dirty way to guesstimate the approximate amount you should pay for a property. But as with all rules of thumb, no concrete decisions should be made unless you've run a real estate analysis on the property. And of course, if you want to do that, check out the BiggerPockets suite of calculators. You can get them at biggerpockets.com/calc, C-A-L-C. Check it out. All right, that's all I got. If you like this video, make sure to give a thumbs up and subscribe to our channel. It'd be great. We'll see you around the site, around the community, around our Instagram or Facebook or wherever you like to connect with us at. For BiggerPockets.com, my name is Brandon Turner, signing off.